Good morning and welcome to this special and abbreviated Wednesday, May 24th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next, maybe 15 minutes or so, featuring everything you need to know as you prepare for the trading day ahead. First, futures had a little bit of a rough afternoon yesterday. Haven't seen too much selling of late, but yesterday certainly the sellers were out. Dow futures looking to continue that move to the downside. Futures down 122 points. S&P 500 futures down 16. NASDAQ futures down 57. So all of them down roughly about 0.4%. We've got crude oil prices moving up, back up over $74 a barrel. That's up about 1.6% today. And the U.S. 10-year Treasury yield, after a pretty hefty stint to the upside, is backing off a little bit. The yield's down about 2.5 basis points. We're back to about 3.67%. Trying to put a lid on it right near some gap resistance at about 370. We'll take a look at that in just a couple of minutes. So today we've got a pretty special day. We're going to have a live trading session throughout the day. So we are going to get started at 8:45 this morning. That's why this show is not at 9 a.m. like we usually have it. That's why it's also not going to be 30 minutes because we need to get prepared for the trading session. But that will start at 8:45 p.m. I do want to just mention to everyone, it's not too late if you want to attend. You do need to be an annual member at Earnings Beats in order to attend. But the silver lining here is that we're running our spring special right now. So we actually have the best deal of the year, which is running currently. So if you'd like to sign up and attend today's live trading event, it's not too late. I'm going to show you how here. Why don't we just do that right now? All right. So if you go over to earningsbeats.com, we have this area right here. You'll see live trading room. All you have to do is click on that. It'll spell out the plans. Once you take a look there, you can drop down here and you'll see there are 3 plans that you can sign up for. If you want to sign up for 1 year, you'll get 2 bonus months. So you'll get 14 months for the price of 12. 2 years, you'll get 6 bonus months. So that's going to give you 30 months for the price of 24. And then 3 years, if you sign up, commit with us for 3 years, we're going to give you another bonus year. So you're going to have 4 years for the price of 3. You can see as you commit further and further, your monthly cost drops further and further. And if you just sign up for a monthly membership to Earnings Beats, it's $147 a month. So, I mean, if you look at these costs down here, you're going to save a ton of money. You go out 3 years, get a 4th year free. You're going to be paying $62 a month. And for those of you who don't know, our market calls over the last couple of years, trust me, $62 a month is cheap, considering the nearly perfect guidance that we've given really since the pandemic began. But just looking back over the last 2 years, calling a market top at the beginning of 2022, watching the S&P 500 drop 28% over the next 9 months, 25% over the next 6 months. We avoided that. In fact, we were encouraging members, if you really wanted to be risky, short the market. So you'd actually be making money while the market was dropping. This year, we've been bullish. We've had a huge run up, especially in the growth stocks. So imagine that kind of guidance throughout this turbulent period at $62 a month. I think it's a pretty good deal. Anyhow, that's our best offer if you want to commit. But if you want to come to today's trading event, the live trading class, it's free to anyone who is already an annual member. We're not charging anything extra. So make sure you go sign up. If you have any questions, there's a subscription form right there on the page. But if you have any questions whatsoever, contact us at support@earningsbeats.com, and we'll make sure we get you set up and so that you can join today's event. All right, so let's move on and talk a little bit about what the heck happened on Tuesday. So Dow Jones dropped 231 points. S&P was down 47. NASDAQ down 160. Mid caps down 24. Small caps down 1. So we did see relative strength in the small caps. I'm going to show you a chart in just a couple minutes of the IWM, but that was a tremendous opportunity yesterday for the IWM. I thought we had a breakout. I actually, during the day, I got a full position in the leveraged TNA, which is 3 times small caps, when we made the breakout earlier in the day. But by the end of the day, we'd given it all back. And what I had added, I just took back off the table, took a loss on that. And now I'm waiting again. I think that the small caps are setting up for a big breakout, but I want that confirmed breakout. I'm not going to hold all that leverage when you get a false breakout. I'm just not going to do it. When I trade leverage, it comes down to risk. And anytime I see a false breakout above key resistance, that's not a good, I don't have great thoughts about that short term. Now, again, long term, I think everything's setting up. I think this is probably just going to be a temporary failed breakout. And I see small caps surging. And I think yesterday in the morning was just kind of a little taste, a little teaser, if you will, of what we're going to see down the road with the small caps. But as of yesterday, it didn't work. And so you've got to be prepared to move back out of some of it if you choose. I mean, there are some of you maybe aren't traders, don't really want to get in and out, in and out, in and out. That's fine. I still like the IWM. I think we're going higher if you want to hold the TNA for a while. Just understand that the TNA is 3 times. It's a leveraged ETF. So for the same dollars, you're going to get 3 times the return or 3 times the loss. So you just have to understand that when you get into these leveraged ETFs. Anyhow, small caps did better than the rest. Most all of the indices really took on the selling in the afternoon yesterday. Energy was the only group to go higher, 1 out of 11. It gained about 1%. We're starting to see crude oil prices move back up again. We did get back up to the 20-day moving average. We got through it intraday. We failed on it at the close, which always bothers me. But we do have crude oil prices up another $1 this morning. So we'll see. Maybe energy can make that move through the 20-day and back through the 50. We've seen a lot of head fakes in the energy space throughout 2023 so far. Wouldn't be a shocker to see it again. But technical analysis 101 tells me watch these moving averages, especially that 20-day, that failure to get through on the close. So if we gap up, we fail again, chances are, I mean, I'm going to say odds. I never ever give guarantees, but I would say the odds on another failure at the 20-day probably mean we could be going back down to the recent low and maybe ultimately back to that 74.75 level that we tested all the way back in March. Among the other groups, the worst performing sector, materials yesterday. Materials breaks back down again. It's been in this downtrend now for about 6 to 7 weeks and looks to me like it is heading for that March low. And I don't see anything on the PPO to change my mind. It looks like we're trending below these moving averages. So ultimately, I wouldn't be surprised if we get down close to that 75 level in March. Just keep in mind, I'm bullish the overall market. I think all these sectors eventually are going to go higher. So even pullbacks, I don't necessarily think we're going to go down forever and ever, but I'm just looking at the key support levels. And if we break down and I look back to where the support is on the XLB, I'd be looking right around 75, maybe just a little bit below. And we're at 77. I mean, it's not like we're that far away. Technology, second best group, second to communication services in 2023. Finally saw some serious profit taking. I don't even know if I'd say serious, but more significant than we've seen recently. We can say that for sure. And what was really interesting about this, and maybe somewhat, I don't want to say confusing, that's not the right word, but technology going into last week, into options expiration, if we had had this day last week, I would have said, ho-hum, yawn, that's just options expiration week. Now, that can drag on to the middle part of the next week, and this is Wednesday of the following week. So maybe yesterday still had something to do with the max pain. Maybe we'll have one more day. I don't think this selling is going to last long, though, honestly. I believe NVIDIA reports, and I want to say that they report tomorrow. I know it's this week. They report today. So they will be reporting after the close today. That's going to be very interesting because I think they're going to have a blowout report. That doesn't mean that stocks are going to go higher. I've seen blowout reports and stocks down 10%. I just believe they're going to come in way ahead of what the market's expecting. Has it already all been built in? That's the question. And that's why holding anything into earnings is so treacherous and so risky. Because a lot of times I could probably tell you 70, 75% of the time, based on how a stock is trading, I have a pretty good sense on whether or not that stock's going to report solid results or maybe so-so or potentially weak results. Just based on their relative strength, how they've been trading over the past couple of months, I think that gives us a big, big clue. But you never know for sure how the market's going to react. Even if you get that blowout report, we've seen it plenty of times before. So I'm watching technology, especially after the close today because of NVIDIA. Communication services also down 1.25%. By the way, technology was down about 1.5%. Materials a little bit more than that. So communication services down about 1.25%. It had made a big breakout above 60. Notice the 20-day moving average sitting at 59.84. Right now, the XLC is at 61.20. I see maybe another 2% downside here in the short term. It could happen today. But if we get down to that support level, this has been the best area of the market. I like trading strength, and I like trading strength on pullbacks. So this will be a group that we'll be taking a look at today in the trading room, looking for individual stocks that might fit the bill on some additional selling today, and maybe even over the next couple of days. And then finally, real estate down almost 1.25% as well. Real estate obviously been very weak. We closed right at $36 beneath both the 50-day and the 20-day moving average. Much more selling, and it certainly, again, looks like we're opening the door maybe to about 34.25, 34.50, which was that March low. So that's the way I see things shaping up based on yesterday's action. Looking over at the 10-year Treasury yield, by the way, the FOMC minutes come out later today at 2:00, and we'll see what happens there. But, we could see a big move one way or the other at 2:00. I mean, I think the Fed is, based on everything that they're saying, they're still throwing out there the possibility that they're not done raising rates. They're just pausing. But I think a lot of that is just talk. It's Fed speak. They want to kind of keep everyone on edge. What they would like to do is just see a very soft landing. They don't want to go out and say, hey, we're done raising. In fact, we see ourselves cutting later this year, next year. They're not going to say that because that's going to give everybody the green light to go out and start spending. And that's really what the Fed wants to try to keep from happening right now. They want to make sure that they have a stranglehold on inflation. And so they're going to use their language, maybe not necessarily their rate hikes, but their language to try to keep things in check from a demand standpoint. But if you've been watching like initial jobless claims, they were several times or a few times anyway, down under 200,000. They've been inching their way all the way back up to 260,000 jobs, or claims, I should say. And so the economy definitely is slowing. I think you can see that in most everything we look at. When you look at the Philadelphia Fed manufacturing or the Empire State manufacturing index, those surveys that are done, top executives are basically saying they see things that are slowing or they expect things to slow. So none of this should be a shocker. I mean, I think that's what the Fed wanted, and that's what we're starting to see. But the question is, does it balloon or is it just going to be a soft landing? And when I see the way the market is trading and the fact that money has gone so heavily into growth stocks, I believe the market is beginning to look beyond any type of a slowdown we have and is anticipating the lower interest rates ahead and the strengthening economy without inflationary pressures. That's what I'm seeing in the charts. You may be seeing something else. That's fine. Everybody can have their own opinions, but that's what I'm seeing in the market right now. And I call what I see. I don't care if it's bullish or bearish. I've been bullish for a year now, and I'm mostly bullish. Most of the time I am bullish. So there are a lot of folks out there that think I'm a perma bull. That's fine. Think what you want. I call what I see. A year ago this time, I was in the middle of still shorting, trading the QID and the SQQQ. Those are the bearish three. Well, the SQQQ is the bearish 3 times the NASDAQ 100. QID is 2 times. I was leveraging on the short side back from January to May of last year, not the whole time, but I was picking my spots. I was shorting rallies. I wrote articles saying, don't trust this rally. Don't trust this rally. Don't trust that rally. Wrote that for 5 months. January to May. Go back and look at articles. Go back YouTube videos. I call what I see. I don't care if it's bearish or bullish. I prefer it to be bullish. I like to see people make money. Most people don't short. Most people are in this market on the long side. Many just jump in and hold no matter what until they get so scared. Then they jump out at all the wrong times. But for the most part, people are long. And I like to see the market go up. I like to see people make money. I like to see people get wealthier. But anyway, I call what I see. And what I see is the market going higher. 10-year Treasury yield, 3.70%. That's where we closed yesterday. I liked that reversal, and I liked it because we were right here at this gap resistance. We had actually gotten just through that gap resistance and then put in a reversing candle. I would expect that we'll go back to at least 3.65% and perhaps even that 20-day moving average, which right now is at 3.56%. That would be welcome little pullback here. I think the overall downtrend remains in place. There's that high. Here's a low. Then we've got a lower high. Then we got the lower low. Now, right now, it looks like so far anyway, lower high. Eventually, I think we go back down below this low. But even if rates stay here, let me show you the 10-year Treasury yield. Let's go back 50 years. I mean, if you go back 50 years, now there are a lot of folks that are going to say, okay, well, we've broken this downtrend line. If you connect this and come down, clearly we've broken the downtrend line to the upside. Now, I'm not quite sure yet if it means that we're just now in a different era, or if because rates went out of the range, I mean, you pretty much could do a channel. And you can see that on a few different occasions, we went below that channel. Maybe this is simply a situation where we went above the channel. Maybe we get back into that channel, which to me would be a drop back down to about 2.5% on the 10-year Treasury yield. Or maybe this is a start of a different period where we've started to move up. I don't think rates are going to continue to move up at that rate. I think the big reason why we moved up like that was because we went down so fast. If you look at almost anything in the market, look at lumber prices back in 2020. They went from 500 to 1,700 and then fell right back to 500. And if you look at a lot of charts look the same way. Big move down, big move back up, or big move up, big move back down. It's all about perspective. Some are just looking at this and saying, wow, we've had such a huge run the last 3 years. This is terrible for the economy. Well, think about just about any other point in time prior to maybe 2011, maybe 2009. 3.7% interest rates. Are you kidding me? I don't know how far this goes back. I think it's into the 60s, but let's see. Here we were at 4% back in the early 1960s. So 1962 is what I'm showing here. I'm not sure if the UST10Y. I don't know if that'll be the same date. Yeah, it is 62. All right, so there's your 10-year Treasury yield sitting at about 4%. Now, is it going to be one of these situations where now that we've gotten back up to 4%, we're going to just keep going up like we did in the 60s and 70s? I mean, that's what a lot of folks think. I don't know if I think that. I will say this. We were going up throughout the 1960s. And you know what? Stock market kept going up, especially through about 67, 68, right in here. rates were only up to about 5 to 5.5% at the peak. That's why I think rates back up to 5%, I think could still be okay for the market. I don't think the market's just going to fly higher with rates going up to 5%, but I think the market could still handle 5%. What I don't think the market handles very well is when you're going up well above 5% and rising. That would be a big problem. And that's what really started to lead to the problems we had back in the 1970s during that secular bear market. So yeah, let's watch interest rates. If I see rates going up to 5.5, 6%, probably not going to have the same attitude that I have right now. I just don't think they're going up there. I think we've already started to roll back over because the inflationary pressure is dying down. And if you don't believe me, believe all the bond traders. Yields go up in anticipation of higher inflation. It's starting to roll over. It's been rolling back over. The Fed's telling us they think they got a handle on it, but they have to remain vigilant. Anyway, we've gone already 20 minutes. I was only going to do about 15 minutes. I did want to point out just a couple things real quick. S&P 500, there's a pullback. We got that temporary breakout above 4179, got up just above 4200, maybe to about 4215, 4220. I don't know exactly. Maybe it wasn't quite that high. 4212. Yeah, 42, actually maybe 4213 rounded. We got up there, taking out the prior February high. That to me starts to talk uptrend. So when you're in an uptrend and you pull back, you start thinking rising 20-day is support. Now, I would say this, that wasn't exactly a big, huge breakout there. I would be watching the 20-day and certainly the recent support down around 40.50 at this point. You had a top at 40.50. You had two lows down at 40.50. The 50 days now above 40.50. If you go back down below 40.50, I think you want to be a little bit more cautious, no doubt. Right now, I think this is just temporary pullback. I believe we're going to go higher. I think we're going to go challenge that August high, and eventually we're going to break out above it. If you look at the NASDAQ 100, we've already moved up, and we cleared the August high, pulling back. But again, let's watch that 20-day. Then we also had multiple tops around the 13,250 area before we finally made this surge over the past couple of weeks. So I would say the 20-day moving average down to that 13,250 area would be an area to watch. So that could be another 3% or so on the NASDAQ, I think, in this pullback. Last week, we were looking for about a 3, 4, 5% pullback, and we didn't get it. Maybe we're going to get it this week. So I think short term, we have to just be a little bit cautious here. The last thing I wanted to point out, I wanted to show you this IWM. And the reason why I think it's so important, if you look at this bottoming formation over here, let me get rid of that. If you look at this bottoming formation right here, notice the reaction high, pullbacks, and then when we finally broke out above that first reaction high, look at what happened to the IWM. Then we come down here again, double bottom. Rise, come back down, hold support, rise. Look at that false breakout. See that tail up there and then closing back down below support? Look what happened the next 2 days. More selling. Before we finally came up, once we made the breakout, nice little rally there. It was almost $10 on the IWM after the breakout. This one was a little bit lesser. We came down, we rallied, we came back down. Look at that false breakout, down for 2 days, and then a big breakout. Look at that rally. This time we came down, rallied back, still within this trading range. This is the top, this is the bottom, just like these previous ranges we've been in. We go back up, can't get through. We go back down. We challenge this low. We come back up. We have the false breakout. Is this not looking exactly like these last two, except it's just a longer duration of consolidation? So I expect maybe we get another day or two of weakness. Maybe the IWM gets back down to the two moving averages. I mean, we've been trading kind of above and below the moving averages. I don't even think the moving averages at this point are that important in a sideways consolidation. Maybe we get down there, though, to test those moving averages, or maybe even we get down to 172.5. That would kind of be my downside. I don't think we go all the way back down to these lows. But watch for this breakout. If we get that confirmed close over 180, I think we're going to have a big run to the upside. And that's what we're looking for in terms of playing that leveraged ETF. So, and I might even get back into the leveraged ETF, the portion I sold. If we pull back and get close to that 20-day or maybe even a little bit below, I may start building it again because I think we're going higher. And the reason I think we're going higher, and this will be the last thing I show you, then we're going to have to wrap up here. The reason I think we're going to go higher in this area is if you look at the small caps, and I've been talking about this recently, but if you look at small cap growth versus value, and let's put this on the chart here. The prior times when we were going down here, you can see we started to show a little bit of growth versus value move to the upside, and then we went to a new low. Then we pulled back here, and you can see we went down, we were at a new low. We came back here, though, look at this low. The growth had been continuously moving higher throughout this period lower. And as we've consolidated, we went down a little bit in growth, but we just set a new high right in here, right before this latest push to the upside. So I like the fact that money is rotated into growth. Why in the world would you be in small cap growth if we've got a big recession ahead and the market's going to get killed? If you really believe that, if you really think this market's going to roll over and going back to the October lows or maybe even below and going to set new lows, why in the heck would money be pouring into growth stocks in the small cap area since November? I think we're getting the same kind of manipulation in small caps that we saw in the QQQ before the QQQ exploded. So watch this group. I'm going to be talking about it more during the trading session, along with some other leveraged ETFs that maybe we've traded in the past or that we may be trading in the future. So again, last call for anyone who is interested. If you go over to earningsbeats.com, hit that live trading room. We're going to get started here in about 18 minutes. You can register by simply clicking on that link, and you can read all about it. If you're new to Earnings Beats or fairly new, these were actual calls made in real time. Been some pretty good calls. Talk a little bit about some of the things we're going to be talking about during today's trading session, how you can be more organized, how you can find the best candidates. Does it guarantee you profits? Of course not. Nothing guarantees you profits. Yesterday morning, I would have sworn to you we were getting a breakout on the Russell 2000 that was going to stick. By the afternoon, we had a reversal. There are no guarantees. So we have to adjust accordingly, and we have to manage our risk. It means sometimes having to sell at a loss. Anyway, we're going to talk about all that. I'm going to show you how we use the stockcharts.com platform with everything we do. We're going to be running scans on our chart list, and our chart lists are simply the way we organize all of our research. And then we scan against it. It's powerful. Anyhow, I hope you can join us. If you scroll down, you can decide, what plan you want. You can scroll down, fill out all your information. And then down here, you've got 3 different subscription plans you can check out. And then reach out. We'll make sure that we get the, I'm sure we're going to send out room instructions to anyone that signs up this morning. We'll make sure they get out to you right away so you can come in and join us. Anyhow, that's it for me today. I'll be back tomorrow with a regular Trading Places Live at 9 o'clock over at Stock Charts TV. So over at Stock Charts, you can get a hold of me right there at Stock Charts TV. Just click on that at 9 a.m. tomorrow morning, and you'll get the next episode. Have a great day, everybody. Hopefully see you in about 15 minutes for today's live trading session. Happy trading, everybody.
Hello, thanks for watching the video. If you enjoyed this content, please consider liking and subscribing to our channel. If you want notifications pushed to your phone anytime we post a new video or we go live, please click the bell next to the subscribe button also. Thanks.